Investors got some pretty big news about SoFi's loan business after the market closed for the week this week, but it's worth covering because this is one of those things that I think is ultimately pretty transformational for SoFi's business. This is moving from a company that's traditionally a bank, and you need to worry about things like loan losses and interest rates and all that kind of stuff, to much more of a technology company. That increases the company's potential addressable market and should increase the potential valuation or multiple that investors are willing to pay. So it was another announcement with Fortress, an investment group that is now going to be funding up to $5 billion of personal loans on the SoFi platform. I want to go through that announcement and where this is going to show up on the company's income statement, because this may not be where you think. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the announcement from April 17th. This came out after the market closed. You can see that SoFi secures $3.2 billion expansion of the company's loan platform business across multiple agreements with Fortress and Edge Focus. So all of this actually started in October when SoFi announced a deal with Fortress for $2 billion for the loan platform business. So that was really kind of the start of this. And I'll get to the potential impact and how this could be expanding the company's loan business, where that's going to show up. But this is a big number compared to what SoFi is giving out in its loans. And what they would like to do is ultimately not take any of those loans onto their balance sheet. They want to just sell all those or operate as a platform for other companies who are willing to take that risk. So this deal expands that. This extension is another $1.2 billion in a 2-year agreement. So this is a $2 billion extension of the loan platform agreement with Fortress Investment Group. So that deal is now going to be $4 billion from that investment specifically. And there's also a 2-year agreement to originate $1.2 billion in loans with technology powered by a joint venture between Fortress and Edge Focus. So in total, this is going to be $5 billion in loans that are going to go into this platform. And this note from Anthony Noto really puts in focus what the company is trying to do here. Help meet borrower demand. So if SoFi has more demand that it can actually handle with the assets that it has on the balance sheet, where is that demand going to go? Are they going to just push those loans off to other companies? Or are they going to service those loans and then just have somebody else fund them? That's what this is. So this is providing more value, more services to SoFi customers, but it makes SoFi's business less capital intensive and more fee-based. And this is where this is going to show up for investors. This is the most recent quarterly report, so fourth quarter of 2024. You can see in this loan platform business section right here, generated $63.2 million in loan platform fees in the fourth quarter. That was $1.1 billion of personal loan volume that was going through SoFi. So that's $1.1 billion worth of loans that companies like Fortress are going to be financing. And the impact on SoFi is going to be $63.2 million in fees. So they're not going to have the liability on their balance sheet, but they are going to generate a fee. But look at the growth of this platform. In 2024, the loan platform business recorded $2.1 billion of volume. But in the fourth quarter alone, there was $1.1 billion of volume. $1 billion in the first 3 quarters of the year, $1.1 billion in the fourth quarter. Now this agreement is expanding by another more than $3 billion. The future of SoFi's business, this is what Anthony Noto has been talking about for a while, is expanding this loan platform business, offering more products to customers, and having more financial partners who are willing to take off the risk so that SoFi doesn't have this risk on its balance sheet. And it's not constrained. Its growth isn't constrained by the assets that it has on the balance sheet, just the way that a traditional bank is. But these fees are not going to show up in the loan business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So SoFi's business is broken down into 3 segments, and that's what these are showing right here. The lending revenue is going to be the traditional lending business. This is going to be everything from personal loans to student loans and mortgages. Those are the 3 main buckets. Technology platform is going to be the Galileo business. That's going to be services to basically other third-party companies that are trying to add some sort of a financial component. The final and biggest growth sector for SoFi right now is going to be financial services revenue. So the traditional lending business where SoFi is loaning money to a customer. So let's say a personal loan, they're loaning out $1,000 to somebody and saying, you know what, we're going to charge you a 10% interest rate. That is going to show up in the lending revenue. And you can see right here from the fourth quarter, the platform fees, the $63.2 million in platform fees, is going to show up in financial services revenue. Well, SoFi is going to indeed be offloading much more of these loans and become more of a platform business on the loan side. It's going to show up in their financial statements in financial service segment revenue. Now, what's going to be interesting about this is the revenue numbers are not going to be nearly as impressive as if they were taking all of that revenue or all of those loans onto their balance sheet. So it's actually going to impact the growth and potentially the absolute value of that lending revenue, but it's going to move its way to financial services, which should be significantly higher margin. So that's the trade-off that SoFi is making. And here's the way that management talks about it. You can see all the different segments. This is P is personal loans, S is student loans, H is home loans or mortgages, and C is credit cards. Credit cards is another big business and growth business for SoFi, but their balance sheet is going to be impacted by all of these. Loan sales, they're not going to be selling credit card loans. Securitizations, they're going to be doing with personal loans. Secured financing, personal loans. Loan platform business, also personal loans. And then referrals is going to be basically all of this. This is something that they do if they don't have the capacity or they don't want to give out a loan, they'll refer you to somebody else. But the expansion of facilities like this allows SoFi to serve more customers and be much more like a tech platform. And that's ultimately what we want the company to be. If you're an investor and you think SoFi is a huge growth platform, it's not because they're going to be generating more on their loans than any other traditional bank, where they're just going to be making a small margin and keep doing loan after loan after loan and leveraging up what they have on the balance sheet. That is one of those traditional bank businesses that I'm just not frankly all that interested in. But what is more interesting is the SoFi platform growing. So if they're able to attract more and more customers to SoFi and then offer them more and more services, so whether that's a personal loan or a mortgage, investing products, they want to be the center of gravity for people's finances. And one of the ways to do that and expand more quickly is to be able to offload those loans through this platform business. So that's what we're seeing with these kinds of agreements. And one of the things I'm going to be tracking in 2025 is what percentage of their loans are actually on SoFi's balance sheet versus what percentage are being offloaded to somebody else through these kind of loan agreements or through securitizations. That's the other way that they're going to sell some of these loans to other investors. But this allows SoFi to be much more of a growth company. And we'll see that if that translates to the company's valuation. As I'm recording today, shares are trading at about $11 per share. And I don't think the valuation is all that unreasonable. Price to earnings multiple on a trailing basis is 27. Price to earnings on a forward basis is 42. But again, the growth is now being uncapped for SoFi. And that's what's ultimately the most important for investors. So this is the kind of agreement. Hopefully we see more of these. As a long-term investor in SoFi, I want to see more of these kinds of agreements in 2025. And with the momentum that we have, I think that's going to be the case. Anthony Noto has been clear that he wants to make this much more of a fee-based business. This is another step in that direction. So look for that momentum. And that's where it's going to show up on the balance sheet, is in that financial services segment, not just in the loan segment. So you're going to want to look at volume or originations, and then also revenue that ends up in financial services. So hopefully that's helpful in understanding why this is such a big announcement, despite the fact that it's not getting a ton of attention. If you have thoughts or questions, put those in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.